Hello and good morning, everyone. Thank you for joining us today. My name is Marissa Streckfus. I am the claims manager for RT ProExec located in Bloomfield, Connecticut. I would like to welcome you to this webinar brought to you by RT ProExec, the Management Liability Division of RT Specialty. In our webinar today, we're going to be discussing key developments during the 2021 in the Directors and Officers Liability arena. We are fortunate to have with us this morning my colleague, Kevin LaCroix. Kevin is an executive vice president of RT ProExec in our Ohio office. Kevin has been involved with D&O liability issues for nearly 40 years. He's also the author of the D&O Diary. Before we get started, just a few words about Ryan Specialty Group. Ryan Specialty Group is a leading international specialty insurance firm that offers wholesale brokerage services, delegated underwriting expertise in the form of binding authorities, and 20 plus national programs and 21 highly specialized managing general underwriters. Ryan Specialty Group's shares are listed on the New York Stock Exchange and trade under the ticker symbol RYAN. Most of you on today's call know about RT Specialty's practice group for professional and executive liability lines, but some of you may not know that RT actually has 20 specialty practice groups. For further information about RT's practice groups, please visit the RT website at www.rtspecialty.com or just contact me or Kevin to discuss further. Before I turn it over to Kevin, just a few quick preliminary pointers. Audience members can ask questions using the dialogue panel in the right-hand column. So we will do our best to answer our questions that you have as they come in, but if at any point we're unable to do so, please feel free to contact Kevin or me after the webinar at any time. Also, copies of slides from today's webinar and a recording of today's session will be made available to all registrants within a day or two after the completion of the session, most likely early next week. We are also interested in your thoughts about the webinar. We would be very grateful if after this session, if you could drop one of us a note or let us know your thoughts about the session. Our final slide this morning is going to have our email addresses. So with that, I'm now going to turn this over to Kevin to lead our discussion. Kevin, please take it away.
Thank you, Marissa, and hello, everyone, and welcome to today's webinar. Thank you all for joining in. 2021 was an eventful year in many ways, and that was also true in the D&O arena. We have a lot to talk about today, so let's jump right in with the first of our 10 topics, which is securities class action litigation. There's a reason why D&O liability observers focus on the annual number of securities class action lawsuit filings, and that's because the risk of a securities class action lawsuit is the most significant risk, D&O litigation risk, that most U.S. publicly traded companies face. The number of annual securities class action lawsuits is also an important indicator of D&O insurers' likely aggregate claims experience for that year as well. The important news for 2021 is that federal court securities class action lawsuit filings were down relative to 2020 and relative to the 4 preceding years of record-setting securities litigation filing levels. 2021 federal court filings were down more than a third relative to 2020, as you can see from this chart. There were 210 federal court securities class action lawsuits in 2020 compared to 324 in 2020. Please note that these figures and this chart do not reflect separate state court securities class action filings. This chart, as indicated at the top, relates only to federal court securities class action lawsuits. There are a number of things going on in these numbers, and the next few slides are going to address these issues. So first of all, I think the question everybody wants to know is, why did the number of securities class action lawsuits file in 2021 relative to the 2017 and 2020 time period? And the reason has to do with the decline in federal court merger objection class action litigation filings. And I'm going to talk about that in greater detail in the next slide. 2 important factors that contributed to the filings in 2021 were the SPAC-related securities lawsuits, and I'm going to be talking about that as topic 2, and coronavirus-related securities class action lawsuit filings, which I will be talking about as topic 3. So let's focus now on those federal court merger objection class action lawsuit filings. And just to unpack this chart a little bit, the light blue section of the bars represents the merger objection lawsuits, and the dark blue section of the bars represents the traditional securities class action lawsuits. And if you look at 2021 and allow your eye to go back to 2015, you can see that 2021 looks a lot like 2015. And that says a lot about what happened in the period 2016 to 2020. You can see that in each of those years, the light blue part of the bar was significantly higher than either before or after that period. And that's because in 2016, there was a development in Delaware state courts that caused plaintiff lawyers to change their tactics and to file their emergent objection lawsuits in federal court rather than state court. And so you can see, particularly in the years 2017 through 2019, there were significant numbers of federal court merger objection lawsuits. The number of objection lawsuits that is dropped in 2021. And that's because the plaintiff lawyers changed their tactics again. Rather than filing their merger objection lawsuits as class action lawsuits, they filed them as individual actions. And I think that's important to emphasize. The lawsuits are still being filed. They're just being filed as individual actions rather than as class actions. If you focus for a moment on the dark blue part of the bar, that is the traditional lawsuits, you'll see that the number of traditional lawsuits in 2021 looks a lot like the number of traditional lawsuits before that ramp up started in 2017 through 2019 and actually into 2020. So though the overall number of lawsuits is down, the number of traditional lawsuits looks a lot more like the long-term historical filing patterns. And in fact, the numbers of lawsuits, traditional lawsuits filed in 2021 is very consistent with sort of that pre-surge period. And we can talk more later about the various factors affecting the number of traditional securities class action lawsuits. So Marissa, that's my overview of the top level numbers of class action lawsuits. I wonder if you have any comments or questions about that.
Yeah, sure, Kevin. So you said in your discussion of these 2021 securities suit filings that the impact of merger objection lawsuit filing patterns, but you said that these traditional lawsuits filings were off like about 12% relative to 2020. So why do you think that those traditional suits declined in 2021 as relative to 2020?
Well, in part, it might just be the ebb and flow of filings. The plaintiff lawyers are busy from all those lawsuits they filed during the surge years. But I think sort of the conventional analysis of why the number of traditional lawsuits was down has to do with the stock market itself. Everyone on this call that has a 401k plan knows that the stock market did well in 2021. The S&P 500 was up 25%, and a rising tide raises all ships. So it may be that there was a little bit of boost under the stocks, and that may have carried some companies through 2021. You know, we're in different economic times now, and that could lead to different results in 2022. But I think sort of the conventional interpretation of why the number of traditional lawsuits was down is just that the stock market was up in 2021. Now, one thing I mentioned, Marissa, is that one of the factors contributing to the number of 2021 lawsuits was the increase in the number of SPAC related securities class action lawsuit filings. And that's topic number two. The SPAC lawsuit filings were a significant factor, but in thinking about why that's so, it's important to look what was happening with SPAC IPO filings. And our first slide here, this information is drawn from SPAC Insider, and you can see that the number of SPAC IPOs and the amount of IPO proceeds from those offerings was very significant, 2.5 times the number of SPAC IPOs in 2021 relative to 2020, and roughly double the amount of IPO proceeds in 2021 relative to 2020. And it's kind of ironic because 2020 was the so-called year of the SPAC, yet there we are with 2.5 times the number of SPAC IPOs and well over 800 SPAC IPOs just in the last 24 months ending in December 31, 2021. So, you know, with that much financial activity, it really comes as no surprise that there was going to be a certain amount of litigation activity, and we saw that in 2021. So this slide provides a summary of some kinds of SPAC-related litigation that was filed in 2021, including those 31 federal court securities class action lawsuits, SPAC-related lawsuits representing about 14% of all of the securities lawsuits filed in 2021. There were also other types of SPAC-related D&O claims, including derivative lawsuits. There were state court direct action alleging breach of fiduciary duty, and there were at least 3 of those. There was the kind of oddball litigation, I would call it, where there were some plaintiffs' lawyers that came up with the theory that SPACs are really investment companies as defined under the 40 Act, and therefore are in violation of the 40 Act for having failed to register as investment companies. And there were also SEC enforcement actions involving 2 companies in 2021. I want to emphasize this last list is not exhaustive. There are other types of lawsuits that were filed in 2021, including litigation over voting rights or redemption rights. There were a certain number of those traditional merger objection lawsuits involving SPAC mergers. So this isn't exhaustive, but it is representative. And most importantly, it shows those 31 federal court securities class action lawsuits. In breaking down those 31 securities class action lawsuits involving SPACs, you can make some generalizations. Most important of which I think is that 20 of them, that's the second line in this bar, this chart, show that roughly 2/3 involved as individual defendants, former directors and officers of the SPAC, and that's obviously important to think about when you're thinking about the liability risks of SPAC directors and officers. There were some other significant factors. Almost 1/3 of the lawsuit filings, 9 out of the 31, involved companies in the electric vehicle industry. 14 out of the 31, or 45%, involved companies that had been hit with a short seller report and had a stock price decline. There were 2 of the 31 that were the defendants named included the SPAC sponsor itself. And in fact, the first SPAC-related lawsuit filed here in 2022 also involved the SPAC sponsor as a defendant. Clearly, a number of patterns emerged among the 31 securities class action SPAC-related lawsuits in 2021. Most of those lawsuits were only just filed, and so we're in the early days, so it's hard to know how they're all going to fare. But there were a number of developments that we can look at in thinking about these lawsuits, the most important of which is that settlement of the Akazu lawsuit filed in 2020, which was a partial settlement of $35 million. There were also these 2 SPAC-related SEC enforcement actions. Notably, in late December, there was the Nikola $125 million SEC enforcement action settlement. Did not involve Trevor Milton, the founder of Nikola, but the company itself did pay $125 million settlement. And thinking about what all this means for 2021, it's important to think about where we are, at least where we were as of 12/31/21. According to SPAC Insider, there were, as of 12/31, 575 SPACs in the search mode looking for merger partners. And that means that at some point over the next 12 to 24 months, or perhaps a little longer, those 575 companies, most of them will be announcing merger partners. And I say most of them because it's pretty unusual for a SPAC to liquidate, even though that's always theoretically an option. As you can see from this chart, during the period 2009 to 2021, only 27 SPACs liquidated, at least so far. Maybe some others will in the future. But the SPAC backers and sponsors have huge financial incentives to find a merger partner. And so we can anticipate that over the next time period, we'll be hearing a lot about SPAC mergers, and SPAC mergers will be completed. And that's important because if you look at the 31 lawsuits, SPAC-related lawsuits that were filed in 2021, the SPAC life cycle event that kind of created the SPAC-related securities litigation risk was either the announcement or the completion of the SPAC merger. So that means a lot of companies are going to be entering that life cycle phase. Many of them will successfully complete their mergers and will go on to successful lives as publicly traded companies, but there are a certain number that will hit hurdles or obstacles and that will see their share price decline, and that could result in securities litigation. And I think we will see a lot of SPAC-related securities litigation in 2022 and beyond. So that's sort of my overview of the SPAC-related litigation. Any comments or questions on that, Marissa?
Yeah, Kevin, we actually got a good question from the crowd about this. Do you think that SPAC filings and proceeds are going to continue to increase in 2022? And what's your position on why they have been growing so exponentially?
Well, here we are. I believe it is 8 business days. It may even be fewer than that into the new year. And as of last night, there had already been 11 SPAC IPOs in 2022. So, from today, I have to assume that there will continue to be SPAC IPOs filed. As for what's causing it, there are any number of dynamics. The amount of liquidity in the economy, I think, is a big factor. There's a lot of interest among prospective investors in these SPAC vehicles, and they continue to be supported in the financial marketplace. And I think success breeds success. And I think as long as those would-be SPAC backers are able to sustain their model, I think they'll continue to be filed. How long it will continue, there are a lot of factors that will affect it. Rising interest rates could crimp it. If there's some, event that, roils the securities marketplace, perhaps the real estate market in China seizes up, any one of a number of things could upset the apple cart. But for now, the evidence is it's going to continue. And certainly that's the way it looks here in January 2022. Time will tell.
Yeah.
Any other good questions? That was a great one. Any other good ones?
Yeah. So I know that in our discussion, you talked a lot about the securities class action lawsuit filings with respect to SPACs, but you did know that there's other types of lawsuits that are SPAC related. So with respect to those, what do you think is particularly worth watching?
Yeah, that actually is a good question, Marissa, because I did emphasize the securities class action litigation, but I really think that Delaware state court breach of fiduciary litigation could be important as direct actions, not as derivative actions. And the reason I say that is there was a decision on January 3rd from the Delaware Chancery Court in the multi-plan case where the court sustained, that is, the court denied the motion to dismiss and allowed the direct action breach of fiduciary duty lawsuit to go forward. And in part, that was because of features of the SPAC itself that created conflicts of interest. And those features are common to many SPACs, although the vice chancellor in the opinion did emphasize that alone was not the reason that the case was being sustained, that there were case-specific factors that created the appearance of potential conflicts of interest that may or may not have been fully disclosed to investors when they had to make their decision of whether or not to redeem their shares. But the fact that that case was sustained, I think, is a significant development. And I think it will be very interesting in 2022 to see whether plaintiffs' lawyers seize on that to file more of those Delaware Chancery Court direct action alleging breach of fiduciary duty, either instead of securities class action lawsuits or in addition to securities class action lawsuits that other plaintiffs' lawyers may have filed. Mm-hmm. So I did mention, Marissa, that one of the factors that drove the securities litigation filings in 2021 was the coronavirus lawsuits. Just as the coronavirus itself has persisted much longer than I think any of us thought or hoped, the securities litigation has continued to be filed as well. And it's been pretty consistent over the 22-month period of the pandemic. In this slide, I kind of break the numbers down a little bit. You can see that during the time period, March 2020 to the end of December 2021, there were 42 federal court securities class action lawsuits filed. There were also 16 shareholder derivative lawsuits and 10 coronavirus-related SEC enforcement actions. The 16 derivative lawsuits, I should mention parenthetically, all involve companies that were also hit with securities class action lawsuits. The 10 SEC enforcement actions were typically very small penny stock companies that the SEC alleged were basically involved in pump and dump schemes where the insiders were trying to make a quick buck. But probably the most important thing on this slide to me is that final box at the bottom, which shows that while there were 24 coronavirus-related securities class action lawsuits in 2020, there were still 18 in 2021. Let's break those down a little bit. What kind of companies were being sued in these lawsuits? And for those of you who read my blog, you've probably seen me make this analysis, but just for those of you who didn't read that, over the most of that 22-month period, the companies that have been sued have fallen in one of three categories. Category one, companies that experience an outbreak in their facilities, and these would be cruise ships, prison systems, meatpacking plants. Category two are companies that try to position themselves as able to profit from the coronavirus. And those would be companies like vaccine development companies, diagnostic testing companies, personal protective equipment manufacturers. And the third category are companies who experience disruptions in their operations or their financial performance because of the coronavirus. In 2021, we saw a fourth category. It is starting in about September 2021, actually in September 2021, and going through the rest of the year. There were actually 6 of what I call these fourth category lawsuits. And these are lawsuits that prospered, involving companies that prospered at the outset, but whose fortunes flagged as the pandemic unfolded. And the one example there in the middle, I think, is one that everybody listening will be familiar with, which is Peloton, the exercise equipment company that, at the beginning of the pandemic, when everybody was stuck at home, there was a surge of demand for their equipment, and they ramped up their inventory. And then as the pandemic evolved, they wound up being stuck with inventory that wasn't moving as fast as before. And that pattern, more or less, was common to sort of each of the 6 of those filed. I think we will probably continue to see those kind of lawsuits as the pandemic evolves and circumstances evolve as well. I do, before I stop that topic, I do want to mention one thing is there have been 2 pandemic-related lawsuits filed already in 2022. So I was going to predict anyway that I thought the pandemic lawsuits would continue, but that certainly does suggest we're going to continue to see pandemic-related lawsuits in 2022. I'll pause there, Marissa. Any questions from the audience or any comments on your part?
Yeah, so you described that there have been many coronavirus-related securities suits filed since March 2020. So now that we were almost 2 years out from that point, how are these cases going so far? Have they been turning out to be good cases for the plaintiffs making them?
Most of the cases have not yet reached the motion to decision stage, but of the 42, 8 have actually had a ruling in the motion to dismiss. And of those 8, the motion to dismiss was granted in 6, and the motion to dismiss was denied in 2. Both of the 2 where the motion to dismiss was denied were vaccine manufacturers who allegedly at the outset had claimed they were going to be able to quickly develop a vaccine for COVID-19. Interestingly, among the 6 where the motion to dismiss were granted, 3 of them involved cruise ship lines. Early on in the pandemic outbreak, plaintiffs' lawyers were very quick to sue the cruise ship companies, but all 3 of the cruise ship companies that were sued had their those complaints dismissed. So those cases haven't turned out. 8 out of 42 is far too few to generalize. So I think it's still pretty early, but I do think it's significant that a significant percentage of the ones where there are rulings have had their dismissal granted. I mentioned my prediction that there are going to be further coronavirus lawsuits in 2022. And one reason I think that is there are economic factors deriving from the pandemic that I think are going to contribute not over to the overall economic environment, but that could contribute to litigation risk as well. And these are factors that I think anyone that's reading the business pages of the newspapers is familiar with: supply chain disruption, labor supply shortage, and economic inflation. And any of you that read the Wall Street Journal or the New York Times saw the headline story today in both newspapers about the top rate inflation level being at levels since not seen for 30 years. So clearly a significant factor affecting the economy. And these are all at some level attributable to the coronavirus, all not exclusively, but they are sort of second level impacts from the coronavirus that I think will contribute to securities litigation in 2022 and beyond. And the reason I think that is there are already some examples of these kind of lawsuits. And I list them here on this slide. The one at the top is Romeo Power, which is they make batteries for electric vehicles, and they had supply chain issues for their battery cells. Their battery cells were stuck somewhere in a boat out in the Pacific, and they weren't able to maintain their production levels. And the investors alleged that Romeo Power misrepresented the durability of its supply chain and so on. I'm not saying I think it's a valid lawsuit, but it does show that there is a connection between the supply chain disruption and the possibility of litigation. Similarly, in the ATI physical therapy lawsuit, this is a company that maintains a national chain of physical therapy clinics, and they experienced A couple of things. First is a number of their therapists on their staff, in the great resignation that we've read about in the papers, resigned or experienced health issues because of the pandemic. For whatever reason, there were labor supply issues for this therapy chain, and they had difficulty hiring replacements. And I think we've all seen examples in various lines of the economy where their labor supply issues. Retail, hospitality in particular experience those kind of issues. One final example of these kind of lawsuits is the Sleep Number case, which it's a bedding manufacturer that experienced disruption in its supply of bedding foam as a result of the Texas winter storms. These examples all show how these big economic factors could lead to D&O claims. I think it's important that the causal connection between the pandemic and lawsuits arising from these economic issues may become increasingly hard to discern. So it may get harder to track coronavirus litigation, but I still think we're going to see, or at least potentially could see, a lot of these kind of cases in 2022 and perhaps even beyond. Any question from the audience on that one, Marissa, or any comments on your part?
Yeah, I was interested in your discussion on the Sleep Number case, Kevin, and the fact that the supply chain disruption here was caused by the Texas winter storms in early 2021, as opposed to being caused particularly by the coronavirus. And so do you think there are circumstances of the Sleep Number case that potentially point to other potential litigation trends?
Yeah, I think the Sleep Number case is really interesting because if you pay attention to the warnings of climate change scientists, there may be increasing numbers of climate events. Certainly, we saw a number of them in 2021, the heat wave in the Pacific Northwest in the United States, the wildfires, the storms in the Midwest during the year, and the Texas winter storm. If we see more of those type of weather patterns, the weather events, will we see more lawsuits like the Sleep Number case? And is this perhaps representative of the kind of litigation, climate-related D&O litigation we might see in the future? I think it's an interesting question. I think it's an interesting example to keep in mind as you're watching whether there are further, extreme weather event related D&O claims, because they could look a lot like that Sleep Number case. So it's something definitely to keep an eye on. I'm going to switch gears now a little bit, Marissa, and talk about a trend that's, it's been in our top 10 for several years now. And I think it's something that most observers do have their eye on, and that's the cybersecurity related D&O claims. I think it's something that I think all of us watch. I think it's something that our clients are interested in. I know that when I speak to corporate boards, in the past, decades of my career, usually what I would talk about was corporate governance issues, but it seems like increasingly in recent years, what they've wanted to talk about is cybersecurity issues and the potential liability exposures. The good news here for those corporate boards is, at least in 2021, the track record for the defendants in cybersecurity related D&O claims was good. There were several high profile dismissals, which I've listed here, the FedEx NotPetya lawsuit and the various Marriott data breach related securities lawsuits and derivative lawsuits. And the dismissals were granted in all of those. And honestly, the track record for the plaintiff's lawyers is not good. Although there is this one example that I note in the bottom box on this slide, which notes that the Ninth Circuit reversed the dismissal in the Alphabet Google Plus data breach case. And it's a somewhat ominous signal because the Ninth Circuit basically credited the plaintiff's allegations that the senior corporate executives of Alphabet should have known or must have known of what was in fact a relatively minor data breach in the great universe of Alphabet. But that was sufficient, the Ninth Circuit found, to reverse the lower court. So while the track record is overall poor, there are positive signs, like, for example, that Ninth Circuit reversal. And I think plaintiffs' lawyers looking at that mixed record still have shown an inclination to file a data breach related D&O lawsuits. And in the top box here, two examples of securities class action lawsuits filed in 2021 related to data security incidents. Although I should note that the Ubiquity case, which is the second of the two in that box, was voluntarily dismissed here in the last 10 days or so. So from the class of 2021, only the SolarWinds case remains. There are these two shareholder derivative lawsuits in the bottom box on this slide, and I want to call those to everyone's attention because I'm going to echo back to those two cases, the SolarWinds case and the T-Mobile case, when I'm talking about a trend in the Delaware Chancery Court, and I'll be referring back to those two cases. So just keep those two in mind. That's a quick overview of the data breach related cases in 2021. Actually, you know what? There's one more point I wanted to make, and I apologize, Marissa. I did want to note that there were 4 securities lawsuits filed in 2021, all involving Chinese companies, all involving companies that were the subject of the crackdown by the cybersecurity regulator in China. Clearly a set of circumstances arguably unique to China, reflecting political issues in that country. But they do show, and I think this is important, they do show how regulatory issues involving cybersecurity could lead to D&O claims. So even though these 4 lawsuits may be unique and attributable to that Chinese-related set of circumstances, that we should all keep them in mind. And in that respect, there has been SEC-related enforcement activity involving companies. And so the U.S. regulators are active, and I think we can count on them continuing to be active. The first American case, I think, is noteworthy because it essentially held that if you're going to report on your cybersecurity, you have to have mechanisms so that the information is being reported up to those responsible for the reporting. The Pearson case is noteworthy because there had been a data breach, yet they continued to repeat disclosures from prior reporting periods, essentially indicating that cybersecurity risks were hypothetical as opposed to accurately reporting that there had been a cybersecurity incident. Those two issues are noteworthy, I think, really because of the issue I made in the prior slide about the vulnerability of D&O claims arising from regulatory actions. So any audience questions or comments on your part from that, Marissa?
Yeah, so notwithstanding the Ninth Circuit reversal on the Alphabet case, why do you think plaintiffs' lawyers are continuing to file these cybersecurity related suits, despite the fact that there's a terrible track record on it?
Well, I mean, at one level, it's just that's what plaintiffs' lawyers do. Fish got to swim, birds got to fly. Plaintiffs' lawyers got to file lawsuits. But there is some at the core, some basis for them to think that this is perhaps going to be a worthwhile activity for them. And if you look at the history of data breach related securities litigation, we do have 2 very high profile examples where the plaintiffs' lawyers produced successful results. The Equifax case, where there was a $149 million settlement, and the Yahoo case, where there was an $80 million settlement. You know, that's enough incentive to encourage plaintiffs' lawyers to continue to try. I also think there's a certain amount of experimentation. They're probing. They're trying to see if they can perhaps establish some type of baseline standard that they might be able to use in future cases. You know, the plaintiffs' lawyers are very opportunistic, and the good ones, at least, are very smart. And I think they're always looking for entrepreneurial opportunities. And I think they just in their forward-looking sense realize that they're going to continue to be data breach cases. There's going to continue to be cybersecurity incidents, and those could prove to be fruitful sources for them to pursue. In the end, I can't always explain the plaintiffs' lawyers, but they're nothing if not opportunistic, and I think they think there's an opportunity there. So let's talk about another important trend, and I think this is one that everyone listening is aware of at some level. Following the social unrest that followed the George Floyd murder in the summer of 2020, there was an increased focus on a variety of social equity and justice issues. And a lot of topics that perhaps had not been sufficiently examined were reviewed in a new light. And one of them is an ongoing concern about the lack of diversity in the corporate boardroom. Not a new issue, but one that's being viewed in a new light, I think, because of the heightened awareness in the wake of the social unrest. And that heightened awareness has led to a number of developments. For example, there have been legislative and regulatory developments. And here on this slide, I review both the legislative developments and the regulatory developments. The most important legislative developments are the two California statutes, which make companies that are based in California, not just that are organized under the laws of California, that are based in California, subject to the gender diversity statute, which was passed in 2018, and the board diversity statute that was passed in 2020. Those two statutes are subject to court challenge by different groups under different theories. And in fact, in 2021, the Ninth Circuit reversed the lower court's dismissal of one of those court challenges. So those court challenges remain pending, but in the meantime, the statutes remain in effect, and the over 600 companies, publicly traded companies, that is, that are based in California, remain subject to the legislative requirements of these two statutes. At the same time, the more than 3,000 NASDAQ-listed companies are subject to the NASDAQ listing requirements, which the SEC approved in August 2021, requiring NASDAQ-listed companies to have at least 2 diverse board members according to the specified timetable in the listing requirements. The NASDAQ listing requirements are also subject to court challenge, but in the meantime, they remain in effect. In addition to these legislative and regulatory requirements, there have also been some lawsuits filed, and followers of my blog know that there have been a total of 10 shareholder derivative lawsuits filed against companies, many of them, well, not all of them, in California. And the allegation basically is that the defendant board members breached their fiduciary duty by failing to appoint a diverse board, or that they misrepresented the diversity at the company and the board. And the theory of the breach of fiduciary duty is that there's social science research showing that companies that have diverse boards perform better than companies that do not. And so the theory is that companies focused on fulfilling maximizing shareholder value would want to have a diverse board. And so the theory goes that the failure to have a diverse board is a breach of the fiduciary duty. Those lawsuits have not fared well. Of all of them that have reached the motion to dismiss stage, the motion to dismiss has been granted in all of the cases. So, the track record for the plaintiffs' lawyers in these cases is poor. They've been closed out. But I don't think even a cynical observer can say they've had no impact. And when I think about what are the impact of all of these board diversity initiatives, including, I would say, the litigation, even though at some level the litigation was superseded by the California bill, the NASDAQ proposal, and even though the litigation has proven to be unsuccessful for the plaintiffs' lawyers, I think it was all part of a variety of initiatives that have drawn attention to the issue of board diversity, particularly for those companies that now are very high profile, that have non-diverse boards. And I think what that means is those companies, in fact, all companies, will continue to have scrutiny. And I think all of these initiatives underscore the fact that, at least in the current environment, board diversity and equity and inclusion generally are board level issues. And that I think that it's going to continue to be a high profile issue for some time to come. And I think that's just part of the atmosphere in which boards are going to be expected to operate. So that's a very quick overview of that topic. Marissa, any questions from the audience on that topic, or any comments on your part?
Yeah, so sort of like the cybersecurity related matters, like the plaintiffs' lawyers are still having a poor track record with board diversity lawsuits. So do you expect further litigation on this particular topic? Or do you think that these dismissals in earlier lawsuits are going to discourage plaintiffs' lawyers? And kind of attach to that, Kevin, even if these actions are unsuccessful in court, do you think that firms are probably just going to sort of internally promote and encourage board diversity, even when these suits may remain unsuccessful?
Well, to your first question, I think that the specific lawyers that were involved in these cases and looking at their track record, I don't think we can expect them to be filing lawsuits just like these 10 that they filed. I think if they file any or other plaintiffs' lawyers file any, it'll probably under a different theory. I'm reluctant to make the prediction that we won't see any, just because the world is round and I can't see over the horizon any better than anybody else. But I do think, any prospective plaintiff's lawyer is going to look at that track record and have to take that into account. Now, your second question about whether litigation has an impact, I think the answer is definitely yes. I think that well-advised boards have to understand that they are going to be subject to scrutiny, and that scrutiny may include, activist plaintiffs working through plaintiffs' attorneys. I'm as cynical as anybody else, and I think the plaintiffs' lawyers are in it to make a buck. When you hear a plaintiffs' lawyer talking about the lofty goals that they're pursuing in their litigation vehicles, that makes for good press releases. But like the rest of us, they have to pay the rent and feed their children. So, that's their primary objective, and that's going to work on whether they file the lawsuits. That said, I do think it's important for everyone to understand that activist investors and institutional investors are focused on this issue, and that they may seek to act through plaintiffs' lawyers in litigation. So however you want to feel about the plaintiffs' lawyers, there are litigants who may seek to use litigation as a tool to achieve social objectives. So that could still happen. And I'm never going to say never on the possibility of future litigation on these topics. There will be future litigation on equity and inclusion issues generally, whether it's with respect to board diversity issues or not. But speaking of equity and inclusion issues, I want to talk a little bit about the long-running trend of D&O claims arising out of sexual misconduct or harassment allegations. And, a little bit of background on why I think this is important to talk about now. I've heard from other people in the industry the view that the Me Too thing is basically played out, and we're not going to see a lot of D&O litigation on this topic in the future. And I'm wary of that. And I really don't think we've seen the end of this. For starters, there's still the litigation that was filed before. And I've got an example here in the top box on this slide of the L Brands case, which settled for $90 million plus the agreement to adopt certain corporate therapeutics. That's going to continue to be a factor. But I think lawsuits are going to continue to be filed. And I've cited one example here that was filed in 2021, which is the Activision Blizzard case, which was a case that was filed against a gaming company that had some pretty negative publicity about its workplace practices, its hiring practices, its advancement practices. And I think that's sort of the prototype of the kind of lawsuit we will see. And so I'm wary of the view that I've heard expressed that this is a trend of prior periods. I really, unfortunately, I feel like we will continue to see these kinds of cases. And in terms of thinking out what the implications are, I think we'll continue to see these lawsuits for a very particular reason, unfortunately, I think there are still workplaces that, have not adapted to the changed environment. And that as long as there are workplaces where the management and the board are not ensuring that there's a safe, respectable, and fair environment, there's going to be the risk of these kind of suits. And I think the settlements like the L Brand settlement show that these kind of cases could have traction. So that's a quick view of that topic. Any questions from the audience on that one, or any comments, Marissa?
Sure. As you said, Kevin, you can't predict the future, but you certainly think there's going to be D&O claims in the future based on sexual discrimination or harassment. Do you have any idea of what kind of particular lawsuit might be coming about when you're talking about that potential future litigation?
Yeah, most of the lawsuits that have gotten high profile, at least so far, have really been about sexual discriminating harassment in the workplace, sort of interpersonal behavior type things, or the failure of the directors and officers to prevent, or failures that allow it to persist. There's a particular type of claim that I could envision becoming increasingly important, and that's about gender pay disparity, equity issues. And I think, unfortunately, in a lot of issues, that's still prevalent. And I worry that some companies have been slow to perceive that problem as a problem, and slow to deal with it. And so, if I were to have to make a prediction, that's where I could see this kind of litigation wave going, is less the pure sexual misconduct, sexual harassment type allegations, and more sexual gender parity. And not just pay. I've emphasized pay, but it could be advancement as well. And I think a lot of industries that continues to be a problem. So I think that could lead to litigation as well. So to talk about a completely different topic. I'm sorry. Lost track of where I was momentarily. To talk about one factor that I alluded to earlier, that's the rise of breach of the duty of oversight claims, particularly in Delaware. And to talk about those, we need to do a little bit of history. For most observers, and I think probably a lot of the people on this call, that there was a landmark case in Delaware courts in the mid-90s, the Caremark case, in which the duty of oversight was first articulated. And as a result, this duty of oversight is often referred to as a Caremark duty, and the kind of lawsuits filed are often referred to as Caremark claims. They've been around for years, but a frequently stated constraint on these kind of cases is the comment quoted here, the second sub-bullet point, that Caremark claims possibly the most difficult theory in corporation law upon which a plaintiff might hope to win a judgment. And that's sort of been the state of play, and was the state of play until 2019, when the Delaware Supreme Court in the Marchand versus Barnhill issued a decision sustaining a breach of duty of oversight claim. And it's one of a series of claims that have been sustained by the Delaware courts since that time, most involving cases where there are allegations relating to mission critical operations and where the board allegedly has disregarded red flags. So having set that background, I want to talk about an important development in 2021, which was the Boeing MAX 737 air disaster case, where the Delaware Chancery Court sustained the plaintiff's allegations, and quoting or echoing language from Marchand versus Barnhill, referring to essential and mission critical operations of Boeing and relating to allegations that the board disregarded red flags. I think it's important for those on this call assessing how important these breach of the duty of oversight claims are and may be going forward. One key observer, and this is Professor Stephen Bainbridge from the UCLA Law School, who runs a blog called ProfessorBainbridge.com, where he commented that, you look at the evidence starting with Marchand versus Barnhill and going through Boeing, maybe Caremark claims are no longer as difficult to plead, thus raising the question for all of us on this call: will we see more of these types of claims going forward? Will we see more claims asserting breach of the duty of oversight? And when you're thinking about that and how important it might be, I think it's important to keep in mind that the Boeing case, 2 months after the Delaware Court of Chancery sustained the allegations in that case, it settled for $237.5 million, all of it D&O insurance money. So this is a potentially important issue. And when you're thinking about what it might mean, I want to harken back to two cases I mentioned earlier, and that is the SolarWinds and T-Mobile USA cases that I mentioned earlier. And in thinking about how those cases might fare, we need to look at another decision that came down from the Delaware Chancery Court in 2021, and that was the Marriott data breach, where the motion to dismiss was granted, by contrast to the Boeing case, where the motion to dismiss was denied. And the vice chancellor in that case said I think may be helpful to the plaintiffs in the SolarWinds case and the T-Mobile case, and that is that in a changing environment, cybersecurity issues, the vice chancellor said in the Marriott case, corporate governance must evolve to address those issues. And more importantly, she said, and this is in the final bullet point, that corporate harms presented by non-compliance with cybersecurity safeguards increasingly call upon boards to ensure that companies have appropriate oversight mechanisms in place. So I think that kind of rhetoric could be useful not only to the plaintiffs in those two cases, but in other cybersecurity breach of the duty of oversight cases going forward. My crystal ball is no better than anybody else's, but I do think we will see increasing numbers of shareholder derivative lawsuits containing allegations based on breach of the duty of oversight. I think it could be an important trend to watch in 2022 and beyond. So any questions on that topic, Marissa? Any comments from you about that?
Yeah, Kevin, so your discussion on these breach of duty of oversight cases focused on matters in Delaware. So are these kinds of cases only of concern for Delaware corporations, or should companies organized in other states be worried about these potential cases too?
It's a good question, and it actually highlights something that it's an error that I think I'm guilty of falling into regularly, which is to focus just on Delaware. So many public companies are incorporated in Delaware that we tend to disregard important state law developments in other states. And there are a lot of public companies that are not incorporated in Delaware. Financial services companies are incorporated in New York, and a lot of high-tech companies are incorporated in Nevada. REITs are incorporated in Maryland. So the law of other jurisdictions is important. And so to get to your question, yes, there were important breach of the duty of oversight developments in other states. And one example is the decision by a federal district court in Ohio applying Ohio law to an opioid-related case against a pharmaceutical wholesale distributor that was accused of having done a variety of bad things that supported the opioid crisis. And one of the allegations the plaintiffs asserted under Ohio law against an Ohio corporation was breach of the duty of oversight. And the court in that case sustained the allegation, which I think is important. It shows that this is an important legal theory that plaintiffs may seek to assert even if they're proceeding under the law of other jurisdictions. So this is an important development even for companies outside of Delaware. In the interest of time, I'm going to move on to the ninth topic, which is developments involving non-U.S. companies. I wish we had more time to talk about this because I think this is really interesting, particularly for anyone on this call that has to deal with non-U.S. based companies. I think everyone who really, whether you're dealing with non-U.S. companies or not, would understand that a non-U.S. company that has a U.S. listing is facing a higher risk of D&O litigation than compared to their home country peers. But in 2020 and 2021, there was an important development that showed another type of U.S. litigation exposure that may face non-U.S. companies, and that is that there were a series of 10 derivative lawsuits filed in New York State court against non-U.S. companies alleging violations of the home country's home company laws. For example, the Bayer case, which is one that I mentioned here, was sued in New York State court in 2020 with allegations that alleged that the board of Bayer violated German law. But this was a lawsuit in New York court. And the lawsuits related to Bayer's ill-fated merger with Monsanto. Now, it's important to note that these companies face numerous hurdles. These lawsuits face numerous hurdles. But when everyone's thinking about how serious the threat this is, I want to cite the Renren case, which is a New York State court derivative lawsuit that was filed against Renren, an internet company based in China, organized under the Cayman Islands laws. And the 2019 suit was sustained by the trial court, and that ruling was affirmed by an intermediate appellate court. And when the case went back to the trial court after the appeal, the case settled in October 2021 for approximately $300 million. There are various features that could have affected the settlement amount. It's important to note parenthetically that, in fact, the court in that case rejected the settlement, notwithstanding the sizable fact, for a number of procedural issues having to do with the way the settlement would have worked. And it's not sure where that case stands right now, but the settlement does show the extent of the risk this type of U.S. derivative claim could represent. So it's an important litigation trend that's worth watching. But in addition to that, there's another trend for these non-U.S. companies that's worth watching, and that is that there were a series of 3 settlements involving collective investor actions in countries outside the United States in lawsuits proceeding under home country laws, not under U.S. laws, that resulted in very sizable settlements. And I've cited the 3 of them there. They're all unique in their own way. I've written about each of them, so if you're interested, you can look up about them on my blog. I think the important thing is that non-U.S. companies face significant D&O risk arising from the collective investor actions under the laws of their home country, and that's a very important trend, a very different trend than what we've seen in recent years, and one that affects the D&O underwriting environment. Any quick questions on that, Marissa?
Yeah, so you mentioned these a few high-profile examples of the collector investor action settlements or judgments. So, what do you think the takeaways are for the D&O insurance underwriters as it pertains to those particular claims?
Well, in my speed, I neglected to mention that the motion to dismiss was granted in late December 2021 in 2 of those cases, including the Bayer case that I mentioned. And that could indicate that these cases may not actually represent the threat that we thought they did. Time will tell. But with that caveat aside, I do think it is something that D&O insurance underwriters outside the United States will want to understand and watch very closely. I also think D&O insurance underwriters based outside the United States, thinking about the D&O risk that their companies face in their home country, need to think about those collective investor actions, because I really think that's an important trend and a trend of the future. And it could spell heightened D&O litigation risk outside the United States that could have very significant claim frequency and claim severity implications. And I think those implications have important pricing considerations as well. In the interest of time, I'm going to move on to the last topic, which is sort of the bottom line. What does this all mean for buyers, and how is it affecting the D&O insurance marketplace? And what does it mean for the experience our clients will have and their D&O insurance renewals? And I think the important thing there and I'm sure everyone on this call understands that we're in a hard market. We have been for some time now, going back to 2018. But the hard market means, especially by comparison to historical levels, that buyers are paying higher rates. They're seeing higher retentions, and they may, in fact, have less capacity available. They may buy lower limits, or there may be lower limits available to them. The pricing increases that we saw over recent time periods began to decelerate in 2021. I would say starting about the 3rd quarter of 2021 and going on from there. That doesn't mean we have a significant price movement going back towards pre-hard market levels, but it does mean the increases could be lower, or some buyers could even see flat rates, at least here in the early period. That said, there are some sectors that continue to be distressed. We in the IPO space, the SPAC IPO space, the DSPAC space, it is still a distressed market. But the good news for buyers is that the higher pricing has attracted new players, and many of those players are up and running. And eventually those players will have an impact on competition. That's why there's a cycle, and those are exactly the kind of things you would expect to see, sort of as early indicators of the move to the next cycle. And those new players are having an impact, and we're seeing it for some buyers at the high attachment excess level, and rates are coming down for some buyers. And that's exactly what you would expect to see as you're looking for signs of movement to the next cycle. But for now, we do expect that we will continue to see that heightened pricing level that's been the case over the recent time periods into 2022. My My line of sight into 2022 is pretty limited. This has gone on much longer than, frankly, I anticipated, which makes me very wary of making any predictions. But for now, the buyers need to understand that the heightened pricing levels that we've been experiencing remain in effect. Any questions or comments from the audience on that, Marissa?
Kevin, I think as always, we're just, want to make sure that the message is right for the insurance advisor. So what do you think that we should be telling clients about what to expect on renewals for this year?
Well, we all want to set expectations at a realistic place. And I think the mistake I think any of us could make now is pointing to some of those early signs of the possible turn in the cycle and getting out ahead of events. For now, I'm very cautious. For now, what we're telling our buyers is to expect pricing that looks a lot like 2021 pricing. And that if there's going to be any relief, it's going to be limited to excess layers. Will IPO companies continue to face the absolute distress pricing they've seen? That's a good question. I don't know. But for now, I'm inclined to be cautious. I'm inclined to be wary and not get too far ahead of events, because I think that we need more evidence of the cycle turn before we start putting that into what we're promising our clients. I think we're just about out of time, Marissa.
Yes, Kevin, we are. And thank you again, Kevin LaCroix, for leading our discussion this morning on the top 10 D&O stories of 2021. And before we break off, everyone, we just want to remind everyone that we're very interested in your thoughts and reactions to this morning's webinar. So if you have a moment, please drop us a note to let us know what you thought about today's discussion. Or again, if you have any questions to those of you who I corresponded with in the chat and Q&A feature. I also would like to thank our RT colleague, Chrissy Schultz, for all her technical help and design input. Chrissy, we couldn't have done this without your help. Thank you so very much. Snaps to you. So thanks again for your time this morning, everyone. We wish you all a very successful 2022, and we look forward to the opportunity to work with all of you. Thank you very much, and goodbye.
Thanks, Marissa. Thanks, everyone.